Hello, my name is Abhishek Jain and I welcome you all to this episode by Chartmojo. In this episode, we'll be taking a deep dive into the business of SBI Life Insurance, what it does, its future prospects, the competition, and the industry, and more. Everything on the other side. SBI Life Insurance, as the name suggests, is into the insurance business in this country. It is one of the leading private players in this country, only behind HDFC Life in terms of market capitalization. The company was incorporated way back in 2000 when this sector was open for private players. Since then, the company has grown massively and currently holds over 23.7% of the market share in the private insurance space. Now, to achieve that feat is no small task. So, let's look into the capacity of SBI Life. SBI Life has an extensive presence across the country through 952 offices, 18,515 employees, a large and a productive network of about 1,47,057 agents, 50 corporate agents, and a widespread bank assurance network of 14 partners and more than 29,000 partners branches. It also has 114 brokers and other insurance marketing firms. The company has presented a strong FY22 numbers, but before looking into that, let's first understand all the ratios and all the variables that are applied for the Indian insurance space. So the ratios and abbreviations that are used in insurance space is quite different from other sectors. We generally don't look into PE and PB ratios as extensively as that we use for other sectors. So let's look into the ratios that we are going to use and understand throughout this video. So the first term that we are going to understand is new business premium. So premiums are collected in two ways. Either people pay it in one go as a lump sum or people pay it annually. So new business premium is nothing but the premium that is due for the first year, both in lump sum and annually that is paid. The second term that we are going to use is annualized premium equivalent or the APE. Now, since you know that premiums are collected in two ways, so to calculate APE, what we do is we add the annual premiums that are paid, annually, and we add the lump sum, but only 10% of it. So the formula is summation of annual payments plus 10% of the lump sum. The third term that we are going to understand is value of new businesses or VONB. Now, VONB simply means the present value of the expected earnings from the new policies that are being generated this year. And thus, value of new business margin or VONB margin is nothing but the profit that is arising from these businesses. Now, the next term that we are going to understand is solvency ratio, which is the ratio of the available solvency margin with the company divided by the solvency margin as required by IRDA. Now, before proceeding further, if you're liking this content, then consider subscribing to our channel if you haven't already, and do share it with your friends and family as well. Now, moving on to the next segment, let's talk about the Indian life insurance sector. The Indian life insurance sector prior to 2000 was only available for the public space, and which was nothing but Life Insurance Corporation or the LIC. After that, it was opened for the private space, and now we have 63% market share with LIC, and the rest 37% is divided among the 24 private players in this space. The narration that the Indian insurance sector is deeply underpenetrated has been going on since a long time. But the advent of COVID 19 has given a huge boost to this sector. Here are some stats for you to understand why we think that this industry has a huge room to grow. Firstly, we can see the composition of population, which simply means how the population is divided if we look into the age groups. So, India has a fairly young population with a median age of 28 years, but that number is going to go up as the years passes, and this number can be anywhere near 35 or 36 in the next 10 to 12 years. What it simply means for the Indian insurance sector is that there will be more people above the age of 35-36 where we get the bulk of insurance policy buyers from. Now we can see the rise in share of urban population. It was at 34.9% in 2020 and it is projected to be at 40.1% in 2030. Now obviously the sale of insurance is directly related to the number of people living in urban areas, as there are more people in urban areas who are aware about the benefits of having life insurance. Next up, we can see the life insurance density. It simply means that how much money is allotted for life insurance as a protection per individual. You can see that in Singapore it is around 4,528 US dollars as against in India which is only $59. Now, this is a number which clearly proves that the Indian insurance sector is highly underpenetrated and there is a larger scope for it to grow. Now, despite having a population of over 140 billion people, the Indian insurance market is only the 10th largest globally and the 5th largest in Asia. However, the growth in premium in the past 20 years has been around 18% CAGR, which is a very decent number. Now, here is an interesting data point for you, which is the protection gap. Now, India's protection gap is 83%, which is the highest amongst its peers. So, what it simply means that if someone has a net worth of rupees 100, 83%, that is rupees 83, is not insured or not covered, and only rupees 17 is covered. And this is on an average in India. As against, if you see in South Korea, the number is down to 55%, which means that 45 rupees out of the total 100 of a net worth is covered under insurance in South Korea. So, what will work for India? Of course, the rising disposable income coupled with awareness about the insurance. This is the only mantra that would work for India going forward. Now let's analyze how well is SBI Life Insurance performing. Well, if you look into the numbers, its compounded sales growth for the past 10 years has been 20%, which is very good. If you see the 5 years number, which is around 22%, and 3 years number is around 23%. This shows the consistency of SBI Life to sell its product across India. Now, looking into its profit growth, the company's profit is growing at around 10 to 11% since the past 10 years. Now, if you look into the price to earnings ratio or the price to book ratio of any insurance company, you might think that the numbers are inflated or it is overvalued. Now, clearly, you can see that the SBI Life Insurance stock PE is around 73.4. Also, HDFC Life, which has the largest market capitalization in the life insurance sector in this country, has a stock PE of around 102. But this doesn't mean that the stocks are overvalued. So, allow me to explain. There is a guideline issued by IRDA which mandates insurance company to set aside a part of their earnings towards future claims. Now this definitely reduces its earning, and if the earnings are reduced, then obviously the price to earnings ratio will rise. Same goes with price to book ratio, because if the earnings are going down, the book value of its asset will go down and thus the P to B ratio will go up. Therefore, we don't look into price to earnings ratio or price to book value ratio. What we look into is the price to IEV ratio. IEV stands for insured's enterprise value, simply means the value of the company. IEV is simply calculated by discounting all the future earnings that can come from all the policies that have been written so far. So it doesn't include the earnings that can be generated from the policies sold later. It only includes the earnings that are coming from the policies that are written so far. So price to IEV is simply put market capitalization divided by IEV. Now, if you look into SBI's price to IEV, it comes around 2.7, as against HDFC Life's, whose IEV comes around 4 times. So next time, whenever you're comparing 2 to 3 insurance companies, make sure that you're checking the price to IV ratio. Moving forward, now let's talk about the numbers of SBI Life. It's FY22 numbers. Now, since I've explained the few important metrics that I'll be talking about now, I won't be explaining it any further. As you can see, the annualized premium equivalent of the company has grown at a CAGR of 14% since FY18. Its IEV number has doubled since FY18 at a CAGR of 18%. It was at 201 billion rupees and now it is at 396 billion rupees. Moving forward, the solvency ratio of the company stands at 2.5 times as against the regulatory requirement of 1.5 times. The sum assured of SBI Life Insurance stands at 5.7 trillion rupees. Its gross writing premium is growing at a CAGR of 23%, and the individual rated premium is growing at 17%. The new business margin of SBI Life is at 25.9%, which is up by 2.7% year on year. And its value of new business, that is VONB, that we discussed before, is up by 39% year on year. SBI Life gets a major boost because of its association with SBI Bank, and that's why its bank assurance, which simply means insurance that is sold through its channel of banks, is around 60%. The agencies accounts for around 30 to 35%, and other channels account for around 5 to 10%. Talking about bank assurance, SBI Life has around 24,000 plus bank branches associated, and it also has other banking partners such as Indian Bank, UCO Bank, South Indian Bank, Yes Bank, Punjab and Sindh Bank, and Repco Home Finance as their banking partners. The company has 5 basket of products divided into protection, financial security, child education, wealth creation, and carefree retirement. So protection accounts for around 31% in the sale of policies, and wealth creation accounts for around 28% in the share of policies. Next comes financial securities, whose share is around 21%, and the least is for child education, which is around 7%. The remaining 12% goes for carefree retirement. Here you can see all the products that are associated with each of these basket. Moving forward, let's talk about persistency ratio. Persistency ratio simply means the percentage of people that are paying their insurance premium year after year. As you can see, the 13-month persistency ratio, that is paying their insurance premium after 1 year, around 88.4% of the people associated with SBI Life insurance pay their insurance premium. The number naturally goes down, and the 61st month persistency ratio stands at 62%. Simply means 62% of the people who bought the insurance policy in the first hand are continuing to pay for the insurance. The company has managed to improve its persistency ratio across the board, starting from 1 year till 5 years. Here you can see the composition of assets under management. The majority of the money is associated with government securities, and debentures and bonds also accounts for around 30% of the assets under management. Equities on the other hand has around 29%. The company has seen a growth of 21% in AUM vis-a-vis FY21, and its debt to equity ratio stands at 71 is to 29. Also, 96% of the debt investments are in AAA and sovereign instruments. Going forward, the management of SBI Life Insurance has said that they'll be using technology to its fullest advantage so that their cost comes down and they can sell the insurance policy to a larger audience. If we compare SBI Life with HDFC Life, we'll see that the numbers are very competitive, but still SBI Life commands a lesser premium as against HDFC Life. Do comment down below, why do you think HDFC Life commands a premium valuation as against SBI Life? Let's look into the shareholding pattern of SBI Life. Around 55.48% shares are with the promoters, 24.15% are with FIIs, and we can see that the numbers didn't go down significantly since December 2021 as against HDFC Life, where the number went down by around 4% since December 2021 for FIIs. The DIIs hold about 12.46%, and the rest of 7.91% is with the public. Well, that's all from today's video. I hope you like our content. If you do, then consider subscribing to our channel, and I'll see you all in the next video.